we're getting into one of my favorite topics. I think it's a different way to think about something than we've seen from a lot of different topics throughout the exam. We're dealing with corporate distributions, and we can think of corporate distributions as filling up buckets. Now, we've got an example on the next slide, which I think will be a better illustration. But generally, think of a faucet, and this faucet has water, and it's filling up buckets. Now, bucket 1 is point 1 here, then point 2 is the second bucket, then we've got point 3 and point 4. Then I'll use actual numbers on the next slide to illustrate how this works. But we're first off using the current earnings and profits from a corporation. Those are taxed as taxable dividends. So any money, any income earned this year, current earnings and profits from the current income statement this year, taxable dividends. Accumulated earnings and profits. Those are earnings and profits from last year, the year before, anything we've got in our vault of essentially retained earnings, but that's a financial accounting term. Overflows goes into the next bucket. If we've got enough to distribute there, then if we're continually distributing more, and this bucket gets filled up, so we don't have any amounts left from accumulated earnings and profits, we're going to overflow into the next bucket. And then from there, the amounts are going to go to the extent of the shareholder's stock basis, and this is considered a non-taxable return of capital because it's kind of like you're just getting your money back, and it's going to reduce your basis. And then this is kind of the infinite bucket. This bucket goes on forever. Any distributions when there's no earnings and profits or basis left are considered taxable capital gains. Now, keep in mind that distributions cannot be classified as capital losses. It's just not you're not going to have a loss from a distribution. You may have a loss from eventually selling your stock, but you're not going to have a capital loss here. So conceptualize this, and then we're going to use actual numbers on the next slide. And maybe the reason I like this so much is because I get to be a little artsy. Here we're going to, again, have our nice little faucet. I get to draw some buckets, some very nice buckets. We do a very good job with this. There we go. We got our buckets. And we're going to demonstrate how this works. Now, these buckets all represent something different. They're all special in their own way. We've got our infinity bucket here. This is the bucket that will just fill up forever at the end. It's kind of the catch-all at the end. This is representing all the distributions. So we've got Corporation X. It's got $15,000 in current E&P, $10,000 in accumulated E&P. This means during this year, they made $15,000. And then in prior years, they've got $10,000. Now, they could have distributed some of this last year. This is just their balance that they've got at the beginning of this year. Shareholder Y has a stock basis of $25,000. Corporation X distributes a total of $60,000 to shareholder Y. First thing, you see a question like this, make sure you're understanding what you're looking at. This question could say they distribute $100,000 and shareholder X has 60% of the company, so they'd be entitled to $60,000. Just something to note, a super common trick, no matter what topic you're in. Maybe they give you the individual amount for the shareholder or the owner, or maybe they give you the total amount and you have to calculate what it is for the individual. Just one thing to look out for. All right, so here we are going to fill our first two buckets, which think of these two as kind of like from the corporation's perspective. And then you've got these two, which kind of are reflective of the shareholder. So again, the first two buckets, this represents the current earnings and profits. This represents accumulated earnings and profits. This represents the shareholder's basis. And then this is just everything after that. Not that CABE is supposed to represent anything. I just wrote that out. All right, so first we're going to take things from the perspective of the corporation. So we're distributing a total of $60,000. Okay, so $60,000 starts coming out. This is the $60,000's in the faucet. And you could tell, I just like this a lot. I'm spending time with this. It's a good one. So we're filling up the first bucket. And this is $15,000, fills up the first bucket. So from there, we've got $45,000 left to distribute because we used up our 15. Cool. Sound good? Sound very good there. So we filled that up. And then we had 10,000 in accumulated E&P. So, all right, overflows here. So we used up 10,000 here. 15, 10. Cool. Now we're down to 35. All right. So that took care of the items from the corporation's perspective. But yeah, we got 35 left to go. So we see that we're going to take the overflow, put it in here. However, this is limited to the shareholder's basis, as we have here represented by B. So this bucket can only hold 25,000, but we got 35. So 25,000 is going to be a reduction of basis, a non-taxable return of capital. So now the shareholder's basis is at 0, and then everything else flows to this infinite bucket, which would just be $10,000. So the classification here would be, first, we've got taxable dividends of the first two buckets of our $25,000. That's $15,000 from current E&P, $10,000 from accumulated. Then the next $25,000 into our third bucket is just the return of his basis. And then we've got the remaining $10,000 that is just your infinite bucket, and that is going to be treated as a taxable capital gain. Kind of just a preferential tax treatment, better than ordinary income. Take what you will. So probably better than taxable dividends as well. And that's how this works. I think it's not too crazy, not too difficult. Yeah, these are great questions. I personally enjoy them. I nerd out over them for sure, as you can tell. That's a good one. Make sure you're practicing items such as these. You can see them in sim format. You can see them multiple choice. It's almost like I don't want to leave the slide. I enjoyed it too much. All right, let's keep moving forward. All right, let's do it again. We've got some different numbers, Corporation Z, and we are going to bring back our items here. Gonna get rid of this. And we've got our buckets. We've got our beautiful buckets, our beautiful illustrations from yours truly. And let's see how this works in this instance. So now we've got, see some different numbers, and we've got a deficit in accumulated earnings and profits. That's not good. Doesn't sound good. Looks like we overextended ourselves and distributed more than we could handle. So let's see what happens if you have a deficit. All right, so let's get rid of the flowing of the buckets. You change one thing. How does it affect the question? All right, so first off, we have instead of 60,000, we now have 50,000 in our faucet to be distributed. And we'll see how this is all treated. So first off, we start with current, and that's normal. Okay, so we say 12,000 goes into here. Cool. So now we have 38,000 left to distribute. Now we get to our funky part. All right, how are we going to treat this? Well, we've got a deficit of 4,000. This does not impact the taxable dividends. This is, like I said, this is from the company's perspective, these first two buckets, and then the last two buckets are for your shareholders' perspective. Now, that's how they likely got to a deficit, is they distributed more than they had in prior years. So we're just adding to our deficit kind of like that. So that is, again, the corporation's problem. That's not our problem as the shareholder. And these questions are usually from the shareholder's perspective. So we're not going to really worry about there at all. So the distribution continues to be treated as a return of capital. So what we're going to see here is that we're going to completely skip this bucket. So we're skipping this bucket because there's nothing to go from there. So it's like put a lid on the bucket, and the overflow is going to jump right over and go here. Now, of our 30,000 can go in this bucket because we've got 30,000 of basis. All right, so far we've got 12,000 of taxable dividends. We've got 30,000 of return of capital, and then we've got 8,000, which is our excess, going into our excess bucket, which is treated as a capital gain. There's no earnings and profits left, and there's no basis left. That's a good one. It's another one down, another great example. Again, we change one thing, what happens? And like I said, this is going to be from the shareholder's perspective, but what happens is that would reduce the accumulated earnings and profits even further. Yeah, sorry to say, company might not be doing too hot, but that's another great example down. Now, these slides are just going to go into more detail on the specific buckets. More detail. That's all I have to say about that. Taxable dividends are payments made by a corporation to its shareholders out of its earnings and profits, whether it's current or accumulated. These dividends are generally taxed as qualified dividend income or ordinary income, depending on the holding period and other criteria. So, for example, as we've seen, Corporation A has got 10,000 in E&P and distributes 5,000 to its shareholders. The 5,000 will be considered taxable dividends. Yeah, nothing too wild. We're just kind of going through what we saw in our previous examples. Current earnings and profits, that's going to be taxable dividends as well as accumulated earnings and profits. Current E&P is going to be generated during the current year. Accumulated is from prior tax years that have not been distributed. Feel free to read through the examples here, but just because we kind of did do examples here already, I don't think we should go through these again just for the sake of time, but they're here if you want to read through them. And similarly, we've got more here as well. Again, going into more detail. Again, not detail that we haven't really covered, just extra detail if you wanted to cover it. We've got the return of capital to the extent of the stock basis. Remember the buckets, the first two buckets, that's a really great way to remember it, is the first two buckets being from the corporation's perspective and the second two buckets being from the shareholder's perspective. I like thinking about it that way. Just more examples to look through if you want to pause, look through these. Just in general, like what these terms are, if you want to take a note of these, just to remind yourself, but I'm not going to read through these here, just as some extra help if you would like. Again, more definitional. If you want to just read through these, when I was creating these slides, I kind of went overkill with some of them. And if I felt that we discussed it enough, just included these, and they're for you. If you want to look through them, read the extra examples, feel free to do so. However, we generally, in those two examples, saw a good representation of what you'll need to know. All right, and here, these are covered elsewhere as well in other lessons, but let's cover these here. Stock dividends, these are generally not taxable unless the shareholder has a choice between stock or cash or slash property, even if you do choose stock. So that's something you could see in a question. The question could say that you had the choice between a stock dividend or cash property. That's just a fun fact to know. Something that you could see in a multiple choice question. Property dividends are taxable to the corporation paying them, as the corporation would recognize a gain on the difference between the fair market value and the property on an adjusted basis. So, for example, here, Corporation L distributes property with a fair market value of $10,000 and an adjusted basis of $6,000. It's kind of like the same treatment as if they just sold it to someone else because they're using this. It's treating it as if you sold it to someone else and then use the proceeds to give as a dividend. You could think of it like that as well. Corporation L would recognize a taxable gain of $4,000. It's the difference between the fair market value and the basis. And this section 1244 worthless stock, this allows certain original owners of certain small business stock to claim an ordinary loss up to $50,000 or $100,000 if you're married filing jointly. If the stock becomes worthless, excess losses can be used as capital losses. So, for example, here, shareholder M, an original owner of Corporation N's section 1244 stock, has a $60,000 loss due to the stock becoming worthless. The company goes under. Shareholder M can claim an ordinary loss of $50,000 and a capital loss of $10,000. Ordinary loss, that's got a lot of different treatment than capital losses, right? Netting together ordinary and capital. Just something else you might see there as well. You're dealing with smaller companies, but it would have to denote that you're dealing with something in that wheelhouse. All right, qualified small business stock. An individual who holds QSBS for more than 5 years can generally exclude 100% of the gain, subject to certain limits, which is generally greater of 10 times the taxpayer's basis in the stock or $10 million. So if shareholder O holds, and again, the question would say, this is qualified small business stock with a basis of 200,000 and sells it for 2.5 million after 6 years. The gain is $2.3 million. We see there just from the difference there. And since shareholder O held the stock for more than 5 years, they can exclude 100% of the gain up to the greater of 10 times their basis, which is $2 million or $10 million. It's a pretty sweet deal, I gotta say. That's very nice. Made a nice fat gain on that. That's really to incentivize small companies, startups, all that good growth in our good old-fashioned American economy. And next up, a liquidating dividend is going to be treated as if the corporation sold the assets. The corporation recognizes a gain on the difference between the fair market value of the assets and their adjusted basis, whereas you may see a SIM. We know that partnerships are not going to recognize any gains or losses on the sale of or the distribution of their assets to their partners. Important difference for if you saw comparisons of entities in a SIM. This is subject to double taxation as the shareholder receiving the assets is taxed on the difference between their basis in the corporation and the fair market value of the assets received. For example, here, Corporation P is liquidating and distributes assets with a fair market value of $20,000 and an adjusted basis of $12,000. Corporation P recognizes a taxable gain of $8,000, which we get from the difference we see there. Shareholder Q has a $15,000 basis in Corporation P's stock and receives the assets. Now, shareholder Q is taxed on the $5,000 difference between the fair market value of the assets received and their basis in the corporation to $20,000 fair market value minus $15,000 basis, understanding the treatment for both groups, both the corporation and for the shareholders.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of cpa.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.